Hello and welcome to Bondcast, our podcast series where we discuss the latest themes and events shaping rates markets. I'm Joann Spadigam, European rate strategist, and I'm joined today by our global market specialists, Robson and Deepika Dayal. So we've just come out of the ECB meeting just now, and of course an unchanged policy decision as was widely expected by us and the market. We've had our 2% terminal rate review for quite some time now, and the market seems to be slowly coming on side, and of course has been helped today by the ECB's communications. I think from today's meeting, the more interesting aspect for the market was really the assessment on growth. And here I think that what's really holding the ECB back from potentially changing their outlook on growth, which is at the moment tilted to the downside, is trade uncertainty. Because overall, I think that the tone we received from Lagarde today was broadly pretty positive in terms of developments we've had on growth, with positives in the private side of consumption as well. So I do think that the message, even though the official communications haven't changed, is still pretty positive for growth and positive for the European Union. So I think with that, the market has now started to reprice their expectations for cuts for the rest of the year. There was one 25 basis point cut price for the year, and that's been powering back through this week. And I think that that is completely in line with our assessment of where ECB terminal should be and in line with the message we had from the ECB. For the ECB to cut rates further, I think we will need to see essentially a shock or a shift in the macroeconomic outlook versus what we have at the moment. The way the ECB sees this is growth risks are, of course, stacked to the downside, but if uncertainty is taken out on the trade side, that clearly helps. And on the inflation side, medium-term inflation, which is, of course, what they are focused on, is still at the 2% target that they are targeting. So net doesn't seem like they've got to do much more. And a 2% ECB terminal rate, which has been our view for quite a while now, remains very much intact. But of course, trade will be one that we're watching going forward.
Yeah, that's all very clear, Joann. I thought it was interesting that you started off there by linking the risks to the outlook that was skewed to the downside with trade deals, and you mentioned it at the end. Obviously, the overall meeting, the ECB sort of promised very little and sort of delivered on those low expectations. But in terms of those trade deals that they'll be looking for, we've obviously had some details or at least reports about possible US-EU trade deal. There was some focus on US-Japan trade deals. So I was just wondering what you were thinking there on both of those.
So it's an interesting one because we've got news that they are quite close to a trade deal in Europe, and 15% is the number that is being cited as where the tariff will land. Now, that's not been confirmed yet, so I think the ECB was really viewing that as not certain yet, but clearly a 15% tariff rate is better than the Liberation Day levels. It's obviously not close to that 10% level that some were looking for, but I think an outcome with the trade deal is clearly better than an outcome where there would have been an escalation in risk, for example. So the market has read that as quite positive from this week and following the headlines that there could be a deal. And again, that's helped our market pricing here. Japan, as you mentioned, Paul, has also reached a deal with the US, and markets have taken those two things together as being quite positive overall. But I think the interesting point in terms of Japan is what it really means for the new prime minister or for the political volatility there as well. Clearly last week, over the weekend, we saw that the ruling party was defeated in the upper house election in Japan, and the PM hasn't really stepped down at this stage. But there were some questions around whether or not that would become a more near-term possibility, because the trade deal was one of the reasons why the PM had not actually stepped down in Japan. So I think that whilst the trade deal is a positive for the market overall, in Japan, the questions around political volatility could still remain and could actually be heightened by the fact that there is trade news and a trade of certainty at this point. And of course, a new PM, a new government comes with fiscal risks, given that the opposition has very clearly campaigned on tax cuts, given that that is one of the biggest voter priorities at this stage. So I think the political noise and political news will continue to be something we watch even outside of trade tensions. Of course, France will be something we watch later down the line in September with budget negotiations as well. So I think absent of when we get past trade uncertainty, there'll still be plenty of political volatility for us to be also keeping an eye on going forward. Moving on a bit to the US now, we of course have the Fed meeting next week as well. Deepika, can you give us your views here and what you're expecting?
Of course, our forecast matches the universal expectation that the Fed will leave the target Fed funds rate at 4.25 to 4.5 for the fifth straight meeting next week. We also do not expect any significant changes to the FOMC statement next week, except with a minor change there being that the characterization of economic activity may change from the solid that we had as of the June meeting to about moderating. We've seen some data over the course of the second quarter where there has been some loss of momentum. So we think the statement would characterize that. The other departure at the July meeting versus the June meeting would be with the expectation that there would likely be two dissents at the July meeting, and from Governor Waller and Governor Bowman. Both of them, over the course of the last month or so, have indicated that they'd be willing to cut rates at the July meeting. With that expectation sort of already built in, those dissents, while the first, since about 1993, when two Fed governors would dissent together at a given meeting, we don't think that would be too much of a surprise. Away from that, we do think the presser, which begins at 2:30 on next Wednesday, Chair Powell would likely reiterate the committee's wait and watch stance that he has been talking about and other committee members have also been talking about over the last month or so. At the June meeting, most committee members suggested that they'd be willing to stay patient given there are risks of higher unemployment and higher inflation over the course of the next few months, given the uncertainty that we've seen from trade and economic policy. And at this point, it's not clear where the size, magnitude, or scope of tariffs will ultimately settle. So from that perspective, we don't think the press will shed any new light versus what we have heard from Chair Powell over his last few appearances. Of course, we also think, and market participants would also be curious about one aspect from the presser would be whether Chair Powell offers anything about the monetary policy outlook beyond the July meeting. At his semi-annual testimony before the Congress, he suggested that to understand the impact from tariffs, he'd be willing to look at data, how it evolves over the summer months. So far, we've just had one set of data, and that has held up well, of course, with some signs that there may be some pass-through from the tariffs already in place to inflation. So with that backdrop, we don't think Chair Powell would indicate that they may be willing to take up cuts, of course, leaving the door open for future action as the data may evolve over the course of the next 2 months or so. And even if we do get a set of data or indications that the tariffs are impacting the labor market or are not creeping into inflation, Fed officials have enough opportunities over the next month or so, such as the Jackson Hole Symposium at the end of August, where they can begin to signal any changes if needed.
Great. So you mentioned, of course, the data that's upcoming that will obviously help the Fed with their assessment. But next week, we also have the key labor market data with the NFPs, as well as the Q2 GDP reports. So how are you seeing the numbers next week, and how do you think that could shift the outlook for the Fed?
Well, you're right. We do have a full economic calendar the upcoming week. And as you correctly mentioned, all eyes will be in Friday's employment report for July. We're looking for an overall gain of 100,000 for payrolls for the month of July. That would be a slight downshift from the above trend or the upside surprises that we saw in both each of the last prior to employment reports. Even so, with this expectation of a slight downshift, we don't think that really alters the trend that we've seen so far in the labor market this year. The other aspect of the employment report that we will, of course, be looking at would be the unemployment rate. The unemployment rate delivered a downside surprise last month for June, ticking down from an almost 4.3 to 4.1. We expect some of that dip to have unwound with the July number, with the unemployment rate rising from 4.1 to 4.2. So we do think the labor market is holding up well. Of course, if you do get a downside surprise, that could muddy the situation for committee members slightly. But we have to remember this is 1 month's worth of data, and we will have the Fed will also have another employment report to look at, along with 2 sets of inflation data before they can really begin to move or shape expectations for market participants. The other data point that we're looking at for next week would be the Q2 GDP report. We saw real GDP growth contract at a quarterly annualized rate of 0.5% in the first quarter, largely reflecting a big drag from net exports, which was mostly a result of the front running of imports prior to tariffs that were announced ultimately. We see a reversal of that, with net exports now adding back to overall GDP growth in the second quarter. So we're now looking for a slightly above trend gain of 3% on real GDP growth in Q2. Of course, this may be masking some of the weakness that we've seen, or at least some of the cooling that we've seen in domestic demand over the course of Q2. So Q2 GDP numbers are likely to be as exaggerated by net exports as they were in Q1. So, of course, we do think the details of this report will matter a little more than they usually do, especially if we start seeing some moderation in domestic demand. And I'm just going to say the one final indicator that I think we and market participants would also be looking at would be the June core PCE deflator estimate. That's a Fed's preferred inflation gauge. We're looking for a 0.3% gain on that measure. That would be the quickest monthly gain since January. While that would still leave the year-on-year rate at about 2.7, that would still be high from the Fed's perspective, which aims to achieve 2% inflation over a medium term.
Great, thanks, Deepika. I suppose to wrap things up, let's have a little Bank of England early sneak preview into the central bank meeting that's coming in August. So, Paul, what are you expecting for August, and what are the markets pricing in at this stage as well?
Yeah, we think, unlike the ECB actually, and by the sounds of it, the Fed, we think that the Bank of England cuts 25 basis points at the August meeting, and the market agrees with that. I think for asset markets, it's interesting that you are getting this sort of divergence, at least short term, where you've got the Bank of England continue to ease, whereas the other major central banks have said they'll pause. There were a couple of things around the decision that I think might be of interest, but I think it's important also just to note here that this meeting won't be the one where they have to make a decision on quantitative easing. That comes in September. And I don't think there'd be anything in the minutes or any reference to that, but they'll be working on that through the summer. We'll get that in September. In terms of the details, these things are always about the formal guidance, and quite often for the Bank of England, actually, the vote count, markets seem to at times obsess around that. You might recall a couple of months ago when Chief Economist Peel unexpectedly voted for unchanged rates, when everyone thought it was everyone on the MPC would vote for cuts. So we're watching that. In terms of formal guidance, we don't think that will change. It's very much the sort of gradual and careful easing of monetary policy. I keep wanting to say cautious, but I'm always reminded that it's actually a careful easing of policy. Governor Bailey has used that terminology relatively recently. The economic data are tracking pretty well in line with the Bank of England's forecast, so there's no real need there. I think you also have to tread really carefully about changing formal guidance. I always think they're like house renovations. If you're not careful, they get away from you really quite quickly in terms of cost overruns. And if you change the guidance, people then start pricing in a series of more aggressive rate cuts or hikes, depending on what point of the cycle that you're in. In terms of the vote count, you could pretty much get any combination. So, on balance, we think it will be 9-0 in favour of that quarter point cut. But you could easily see a couple of the MPC voting for 50. So you get 7-2. You could easily get 8-1 with Peel once again voting for unchanged rates. Of course, he didn't want the MPC to cut rates last time. So if he was true to what he was expecting, then they've delivered a easing monetary policy that he didn't believe. And of course, you could even get 6-2-1. You could get a majority in favour of cutting. You've got two that wanted bigger cuts of 50, and you've got one person who thinks that they shouldn't be. In terms of the outlook for monetary policy, we think there's going to be enough in the data for a further cut come November. I remember last week we spoke about the recent inflation numbers. They've been higher than expected, but it's those employment numbers that have been revised pretty dramatically. And if you're a central bank that's been backward looking, a little bit cautious in cutting interest rates, the fact that the labour market isn't easing as quickly as perhaps you thought, or certainly on the first cut of data, then I think you want to go relatively cautious. And we haven't actually heard, I don't think, from MPC members since we had that set of data. So watching the minutes for any reference to that. Making it a little bit more difficult from the Bank of England. We had some PMIs today that showed increased cost pressures, price pressures, but weakening employment and weak output growth. So you take those official data with the survey data and it's pretty unclear. In terms of market views, we would push back on anything that suggests that the Bank of England thinks terminal is below 3.5%, which is roughly where markets are. We think they might get a bit of a squeeze after once we get past the August MPC meeting. We still think that 10-year gilts underperform. I don't think it's a curve trade, given our front-end rates view. And equally, I think those sort of long positions in the 30-year, I think might come under a little bit of challenge as well. So really about front ends getting squeezed, go with the sort of underperformance of the 10-year and watch for those positions to be squeezed in sort of long end flatteners that seem to be in vogue over the summer.
Thanks, Paul. Thank you to both of you for joining me today and to our listeners for listening. If you did like today's episode, don't forget to subscribe and like as well. Speak next week.